Hello, everyone, and welcome back to the Deep Dive. I hope you are having a fantastic week and are really ready to tackle one of the most durable, powerful, and frankly, intriguing names in enterprise technology today. Today, we are undertaking a deep dive into the professional services giant, Accenture Pilicyco, ticker ACN. This is a business built on, well, just extreme global scale, an unparalleled reputation, and sheer human expertise. I mean, they're generating over $60 billion in revenue annually. It's massive. But the central question, and this is the one that makes this investment thesis absolutely fascinating right now, is this. Accenture is currently reaping billions from the massive necessary shift to generative AI. They're positioning themselves as the indispensable guide for corporate transformation. But does that same technological tidal wave, the very force driving its current growth, hold the potential for, well, an existential threat that the market is entirely missing? That paradox. That's really the core of what we need to dig into today.
That is a massive question. Absolutely. And it forces us, to look far beyond just the next quarter's results. We have to think about the structural changes happening in the global economy. To be truly informed about a quality business like Accenture, we need to understand its vulnerability profile just as much as its strengths, maybe even more so sometimes.
Exactly. And before we jump into the first pillar of the analysis, just a quick note for everyone listening. If these discussions inform your investment strategy, well, you really need a professional-grade platform, one that can execute globally and handle the complexity of international filings. We personally use Interactive Brokers because, frankly, they offer superior tools and access.
Right. And we've actually partnered with them to get you a stock bonus when you sign up using the link in the description below. So you get a bonus and support the channel at the same time. It's a win-win.
Yeah, exactly. Having that strong, reliable platform lets you execute when those high-quality, maybe temporary buying opportunities inevitably appear, which, as you know, is often crucial for compounders like an Accenture.
Couldn't agree more.
That's absolutely right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know, and honestly, to ensure you receive the next deep dive, is to subscribe and like the video. It truly helps the channel grow. And if you have any questions regarding Accenture, please drop them in the comments below. We actually love reading those and seeing what you're thinking.
Perfect. Okay, let's set the stage then. We're starting with the foundation of the business. Really understanding why this company has been such an economic fortress for decades, and crucially, why clients keep coming back year after year. Pillar number one, the business and the competitive fortress.
Okay, let's unpack the core model. When you really boil it down, Accenture's business is, I think, elegantly simple, despite, the dizzying complexity of the technology they actually implement.
It is, surprisingly so. I mean, fundamentally, they sell organized human expertise, they sell project management discipline, and they sell customized technological solutions. And that generated nearly $65 billion in fiscal year 2024 revenue. That's split, roughly, between strategic consulting fees, those tend to be the shorter, high-value projects, and then the long-term managed services, which is, the BPO or the outsourcing side of the business.
Right. And I think the real durability here, the reason this model has lasted so long, comes down to what it's anchored to. They aren't just anchored to a single piece of software or like a specific cyclical trend. They're anchored to structural constants.
Exactly. That's the key insight. Their entire engine is fueled by two constants that have defined corporate life for, well, the last 50 years and will probably define the next 50. First, there's just a relentless, perpetual, even accelerating pace of technological change. Think about it, from the internet rollout to ERP systems to cloud migration, and now, generative AI. Large enterprises simply cannot, on their own, quickly understand and implement these huge paradigm shifts at scale. They need an external guide. They just do.
And the second constant is the inherent complexity. And let's face it, the inertia within large organizations themselves. We're talking about massive Fortune 500 companies dealing with these spaghetti networks of legacy systems, complex global regulatory environments, multicultural workforce management. It's a mess inside sometimes. These internal knots are almost impossible to untangle purely from the inside.
Absolutely. So when you combine those two constants, rapid tech change, and internal complexity, you realize the need for a company like Accenture isn't cyclical. It's structural. It's always there. They position themselves as the necessary partner for corporate reinvention because internal teams, honestly, they just don't have the bandwidth or the political capital or often the specialized knowledge to execute a transformation that touches every single corner of the business.
And this leads us to what I think is their true, maybe unspoken core product. The de-risking of these massive multi-million or sometimes multi-billion-dollar transformations. Just imagine you're a chief information officer, a CIO, signing off on a new, say, $800 million global SAP implementation. Failure isn't just a cost overrun. It can permanently damage the company's operations and, critically, it can end that CIO's career. The stakes are incredibly high.
Exactly. So when they hire Accenture, they aren't just buying access to, what is it now, 774,000 employees? No, they are buying a safe pair of hands. That's the phrase you always hear. They are purchasing the institutional track record, the brand, the reputational backing that drastically increases the perceived probability of success. It is, as you said, an extremely high-priced insurance policy, really, wrapped in a consulting service. The reliability and the brand mitigate that career risk for the client executive. That's invaluable to them.
Okay, so they can charge a premium because they de-risk things. But how do they maintain that premium pricing power over time? That brings us to the moat, right?
Right, and Accenture's competitive fortress, it's protected by what Charlie Munger famously called a Lollapalooza of advantages. It's this powerful, synergistic combination of factors where the combined effect is, well, it's nonlinear. It's much greater than the sum of the individual parts.
Okay, let's break down that synergy then. You're saying the two primary intersecting factors are intangible assets and high switching costs. Let's start with the intangibles. First, the brand. I mean, they are universally recognized as the leader, aren't they? That alone has to be a powerful psychological advantage, especially in competitive bids.
Huge advantage. And that brand is built on decades of deep strategic client relationships. What's truly fascinating when you look at the numbers is the concentration of power this represents. They serve over 9,000 clients, sure, but that includes an astonishing 94 of the Fortune Global 100. They are deeply integrated into the biggest, most important companies on the planet.
Well, 94 out of 100.
Yeah.
And you can actually see this integration deepening actively, can't you? I was looking at the growth in their diamond clients. Those are the largest, most strategic relationships they have. That number jumped from 229 in fiscal 22 to 310 in fiscal 24. That growth, that's proof the fortress is expanding, is that these aren't just one-off projects. These are multi-year, multi-service partnerships.
Exactly. It shows increasing reliance, and this is all underpinned by their human expertise, which they themselves consider an intangible asset. And they invest massively in this. I think you mentioned they sank $1.1 billion into employee training in fiscal 2024 alone. This investment creates specialized capabilities in areas like cybersecurity, cloud infrastructure, and now AI that competitors simply cannot replicate quickly. It takes time and huge amounts of money.
Okay, so strong brand, deep relationships, and constantly refreshed expertise. That's the intangible side. Now, how do the high switching costs complement that? Why are they so high?
Well, it's because the solutions Accenture implements are not just standalone software packages you can easily unplug. They are deeply, deeply woven into the client's critical IT infrastructure and their core business processes. Think HR, finance, supply chain management. Pulling that thread out, trying to replace it, is prohibitively expensive and incredibly disruptive to the client's operations. Sometimes it's almost unthinkable.
Right. And then there's the other piece, the sort of softer side of switching costs.
Right.
They accumulate institutional knowledge. This is like the hidden asset, isn't it?
Absolutely. It's huge. They learn the client's peculiar internal culture. They know where all the skeletons are buried in the legacy systems. They know who has political influence inside the company and who doesn't. That deep, contextual, almost non-transferable knowledge is incredibly sticky. It further locks the client in for the long term because bringing a new vendor up to speed on all that, it's a nightmare.
Yeah, you'd lose years. Okay, so this all brings us back to that career risk mitigation point, which seems to be the psychological engine driving the moat. Let's play out that scenario you mentioned again. A CIO leading a major, maybe 4-year, $600 million project. If that project is run purely by internal teams, that CIO owns 100% of the failure risk. It's all on them.
Precisely.
Yeah.
But when they hire Accenture, the whole narrative changes, doesn't it? If the project is a stunning success, well, the CIO gets credit for assembling the best team in the world, for having the vision to bring in the leaders. If, however, and this is critical, the project encounters those inevitable delays or cost overruns, which, let's be honest, happens in probably 90% of massive transformations.
Yeah, it's unfair.
The blame gets diffused. The justification to the board, to the CEO, is always, look, we engaged Accenture, the global leader. If they struggled, it just proves how incredibly complex our problem was. It wasn't our incompetence.
That political safety net, It's invaluable.
Yeah.
It gives Accenture this inherent advantage in repelling competitors, especially for those high-stakes projects, and it justifies them charging premium pricing for projects where the margin for error is effectively zero. You're paying for peace of mind, really.
Yeah. And we're seeing concrete evidence right now that this moat is actually widening. It's being driven by two key initiatives, I think. First, the sheer technological complexity of generative AI, which demands massive external support for almost every large company. And second, their really programmatic M&A strategy. They've done over 140 deals in just the last 4 years, systematically acquiring niche expertise in data, cloud, security, buying the talent they need.
And Gen AI is now just pouring fuel on that fire, isn't it? They've committed $3 billion specifically to boosting their AI capabilities. They're already generating nearly $900 million in Gen AI-specific revenue, and they reported a massive $3 billion in new Gen AI bookings in fiscal 24 alone. So as they embed these proprietary AI-powered solutions into their clients' processes, that just deepens the integration further and raises those switching costs even higher. It makes it harder and harder to lead.
It all flows into what we analysts like to call the virtuous cycle. It really works for them. Their global scale and trusted brand allow them to win the most demanding marquee projects. Winning those high-profile projects is what attracts the very top talent globally. That successful execution generates prodigious free cash flow, which we'll definitely get into later, which is then reinvested heavily back into the cycle. $1.1 billion in training, $6.6 billion in M&A just in FY24. This enhances their capability, which strengthens the brand, which allows them to win the next wave of complex projects. It's a self-reinforcing, momentum-driven system that's very hard for competitors to break.
Okay, so if the moat is that strong, and maybe even widening, who are the competitors they're constantly fighting against day to day? How do they maintain that dominance? You mentioned the landscape is fragmented.
It is quite fragmented. You can sort of categorize their main rivals into three main groups, I'd say. The first group is the traditional Big Four accounting and consulting firms: Deloitte, PwC, EY, and KPMG. They are formidable competitors, no question, especially because their historical audit practices give them these deeply entrenched relationships with C-suite executives and finance teams. They have high credibility, particularly in strategy.
Okay, Big Four. Then who's next?
Then you have the big IT services and outsourcing behemoths. Think companies like TCS, Infosys, Wipro, maybe Capgemini. These firms compete really fiercely on price and on massive scale implementation. They leverage these colossal offshore talent pools for what some people call the body shop type of work, large scale coding, system maintenance, that sort of thing.
Right, the execution muscle.
Yeah.
And the third group?
And then sort of at the very top of the value chain, you have the elite strategy firms: McKinsey, Bain, BCG. These firms compete for the highest echelon conceptual strategy work. They're seen as the pure brains of the operation, designing the big picture.
Okay, so Big Four, IT outsourcers, elite strategy. Accenture's enduring advantage, then, seems to be that it's really the only global player that successfully operates right at the intersection of complex C-suite business strategy and massive-scale technology implementation. It seems to be the only one that credibly bridges that gap globally. Is that fair?
That's exactly it. Think about what that means in practice. The elite strategy firms, like McKinsey, they can design the perfect, theoretically brilliant new operating model, but they lack the tens of thousands of engineers required to actually build and implement it across a global company. They just don't have the scale on the tech side.
Right, they hand off the plan.
Exactly. And the IT outsourcers, conversely, they have the armies of engineers, but they often lack the deep C-suite trust and the strategic credibility to design the initial high-level transformation plan. They're often seen more as implementers than strategic partners.
Okay, so Accenture kind of sits uniquely in the middle.
Precisely. Accenture walks into the client's office and essentially says, look, we will help you design the new AI-driven strategy, and we will deploy 10,000 people across 5 countries to execute it flawlessly for the next 5 years. That end-to-end capability from whiteboard to global rollout is incredibly rare at their scale and level of quality. So they effectively extract market share from the elite strategy firms by offering reliable delivery, and they extract share from the big IT outsourcers by offering that high-level strategic insight and C-suite relationship. It really does make their position quite unparalleled and highly defensible. It's a sweet spot.
Okay, we've established the fortress seems incredibly strong externally. The moat looks wide and deep. But, a fortress is only as good as the people running it and the resources supporting it from the inside. So let's transition now to talk about management, stewardship, and capital allocation. How are they running the ship? Hashtag 2.1 management, stewardship, and capital allocation.
Yeah, absolutely critical in a human expertise business like this.
Hmm.
The quality of leadership is paramount. The current CEO, Julie Sweet, her management philosophy seems centered on what they call 360-degree value, which means prioritizing long-term value creation for all stakeholders, clients, employees, shareholders, society, which often means, importantly, sacrificing some short-term earnings optimization for better long-term strategic positioning.
And you can really see that approach, can't you? It demonstrates what I'd call a truly owner-oriented mindset. I mean, look at their commitment to investment, even during periods where IT spending might be slowing down cyclically. In FY24, a somewhat tougher year, macro-wise, they still committed $6.6 billion to M&A and $1.1 billion to training. They're clearly prioritizing market share gains and building future capabilities, especially in AI, rather than just managing rigidly to a quarterly earnings beat. For long-term investors, that's a massive green flag. You want management investing through the cycle.
Absolutely. And their capital allocation track record overall looks disciplined and pretty transparent. The vast majority of their free cash flow after the dividend is aimed at that programmatic M&A strategy we talked about. They specifically target small to medium-sized firms that have niche capabilities. They need specific cloud expertise, maybe a unique AI modeling skill set. They aim to deploy roughly 25% of their operating cash flow toward these tuck-in acquisitions each year. They're essentially buying talent and specific capabilities rather than trying to build everything slowly from scratch. Internally, it's faster.
And they balance that growth reinvestment pretty well with strong shareholder returns, don't they? In fiscal 2024, I think the number was $7.8 billion returned to shareholders through a combination of share buybacks, $4.05B, and dividends, $3.02B. The fact that they've maintained and actually grown the dividend for 20 straight years, that speaks volumes about their financial discipline and the predictability, the resilience of their cash flows.
It certainly does signal confidence and consistency. However, we absolutely must introduce a potential structural risk here. It's something worth monitoring, especially if you have a multi-decade investment horizon. Insider ownership is extremely low. It hovers at about 0.07%. That's
right.
tiny.
Yeah, 0.07%. That figure is strikingly low for a company of this size and maturity. But isn't the executive compensation structure designed to sort of mitigate this? I thought they require executives to hold company equity equal to at least 6 times their base salary. Doesn't that high equity requirement align their incentives enough, even if their actual percentage ownership is tiny?
That's the argument, and it definitely provides a strong mechanism for alignment, particularly over the executive's tenure at the company. You're right, having millions tied up in stock you have to hold certainly focuses the mind. But, the difference between a mandated holding period for compensation granted stock and a truly massive generational personal stake bought with one's own capital, it's subtle, but I think it's important. When direct ownership is that low, the individual leader's personal wealth is generated primarily from their annual equity compensation grants and cash bonuses, not necessarily from the deep long-term compounding of a massive personal equity position they chase to build. This hypothetically, and I stress hypothetically, creates a slightly higher risk that, on the margin, decisions might lean towards protecting short-term optics, or maybe hitting metrics tied to personal bonus targets rather than pursuing absolute long-term per-share value maximization above all else. It's probably a low probability risk for a company like Accenture with its reputation, but it's a structural factor that shouldn't be completely ignored when you're analyzing leadership incentives over, say, 20 or 30 years. Just something to keep an eye on. Hashtag #TAC to the financial fortress, the cash machine.
Okay, a point worth noting on incentives. Now let's look at the financials themselves. The numbers paint a picture of, well, a real financial fortress, don't they?
They really do. Looking at the financials, Accenture is truly a robust vessel. The consistency and profitability is remarkable, especially for a professional services firm operating on this kind of global scale. They've consistently maintained net profit margins in the double digits, around 11.2% in FY24, which shows real resilience.
But the real testament to the quality of the business model, for me at least, is the return on invested capital, or ROIC. This figure has been consistently excellent. It's stayed well above 20% for the past decade, which is just stellar. That's the hallmark of a capital-light business model, combined with strong competitive advantages. It allows them to generate very high returns on minimal physical assets.
It is stellar, though we should probably address the nuance of the trend here. While it's still excellent, we have observed a gradual compression in ROIC over the last decade or so. It's moved from figures that were sometimes north of 40% way back down to the low to mid-20s today. Still fantastic, but the direction is down.
Right. And that compression isn't necessarily a sign of a weakening core business, is it? It's more like an expected, almost mathematical outcome of their growth strategy,
Yeah.
correct? Because they are such a serial acquirer, they're constantly adding goodwill and intangible assets onto the balance sheet from those 140 plus deals. That increases the denominator, the invested capital part in the ROIC calculation, even if the underlying business profitability remains strong.
Precisely. That's exactly the dynamic. They are effectively buying growth and capability, and the accounting cost of that growth shows up in the ROIC calculation via increased invested capital. The returns are still exceptional. Anything consistently above 20% is world-class. But the trend is a good reminder that even strategically sound, programmatic M&A is not without financial consequence reflected in metrics like ROIC.
Okay, understood. And crucially, maybe the most impressive financial aspect is that the business is just a prodigious cash-generating machine. You have to look at the free cash flow conversion ratio, basically. How much of their accounting net income actually translates into real spendable cash for the company. It is consistently and significantly above 100%. For example, in FY24, they generated $8.6 billion in free cash flow from $7.3 billion in net income. That's a conversion ratio of 118%. Just incredible.
It really is. That conversion ratio is powerful proof of the capital-light nature of the business. They turn accounting profits straight into spendable cash because they have minimal needs for heavy capital expenditure, unlike, say, a manufacturing company building factories or an energy company drilling wells. That cash is then immediately available for the things we discussed. Funding those M&A deals, paying out dividends consistently, and buying back shares. It fuels the whole value creation engine.
And finally, just to round out the financial picture, the balance sheet, it looks pristine, doesn't it? They operate with a net cash position of nearly $1.5 billion. They're holding about $9.64 billion in cash against roughly $8.17 billion in debt as of the last report.
Yeah, very strong. That financial flexibility is absolutely critical. It ensures they can execute those strategic M&A deals when opportunities arise. They can maintain and grow the dividend even through economic downturns, and generally capitalize on opportunities when competitors might be struggling or pulling back. They are built financially to weather almost any storm.
Okay, financial fortress confirmed. Now let's pivot a bit and apply some scuttlebutt analysis. Step outside the official reports and the numbers to hear what customers and, perhaps more importantly, employees are actually saying about the firm day to day. What's the word on the street?
Right, the qualitative side. It's fascinating here. Customer sentiment seems to be this unique blend of very high respect and deep reliance, rather than, say, genuine adoration or love. Clients absolutely view Accenture's services as mission-critical. They consistently praise the firm's strategic consulting capabilities and its unique ability to manage those enormous, incredibly complex transformation projects. They're often seen, almost grudgingly sometimes, as the necessary giant in the solutions industry. You have to call them for the really big stuff.
Okay, so respect and reliance, but maybe not love. What about the criticism? What are the recurring complaints you hear from clients?
The criticism is also remarkably consistent, and you hear it frequently. Number one is the high cost of services. That premium pricing we discussed definitely causes some grumbling. And number two, often are concerns about the quality or experience level of the on-the-ground implementation teams. Clients sometimes report friction, project delays, or cost overruns when the execution staff assigned to their project maybe lacks the deep, bespoke expertise of the high-level senior partners who sold the deal. There can be a disconnect between the A team that sells and the B team or C team that delivers day to day.
Ah, the classic consulting dilemma. But here's the critical insight, isn't it? Despite the high cost, despite the occasional friction, clients tolerate it. Why?
Because at the end of the day, Accenture reliably delivers the ultimate transformation outcome, especially on the most complex projects. And just as importantly, maybe even more so, they provide that crucial psychological safety net for the client executives. For mission-critical, career-defining work, that reliability and risk reduction seems to trump cost sensitivity or minor execution bumps along the way. They still get the job done.
Okay, so clients tolerate the premium. Now, what about the internal perspective, the employee view? This seems much starker, doesn't it?
Oh, much starker. There's a real dichotomy here. Officially, as you know, Accenture is highly decorated. They appear frequently on all the Great Place to Work lists. They heavily promote their immense learning opportunities and the $1 billion they invest in employee growth and training. The external PR is very positive. But when you dig into anonymous employee forums like Glassdoor or Fishbowl or talk to former employees, a very different picture often emerges. The culture is frequently characterized by intense chronic burnout, really excessive hours being the norm, and sometimes a pervasive feeling among junior and mid-level staff of being treated as a fungible cost factor, a resource to be deployed rather than a truly valued intellectual asset.
That sounds like the leaky bucket risk we sometimes talk about. And for an expertise-based business, that had to be a massive long-term threat, right?
It absolutely is. If the people are the product, then high employee churn is a fundamental structural vulnerability. It's not just about the direct costs, recruitment fees, retraining time, although those are significant. The indirect cost is potentially far more severe. The constant loss of that non-transferable institutional knowledge about specific clients, specific industries, specific technology implementations. Every time an experienced consultant walks out the door, a piece of the firm's collective brain walks out with them.
And the ultimate risk here, the one that connects back to their future, is the potential failure to win the war for talent, especially for the very best AI, cloud, and specialized engineering minds that they need going forward. If a competitor, maybe a tech giant or even a smaller boutique firm, can offer a culture that's less grueling, more intellectually stimulating, and more sustainable long-term, it could slowly start to erode Accenture's core advantage. They need the best brains in the world to maintain their premium positioning and execute these complex AI transformations. And if those brains are constantly walking out the door due to burnout, well, the quality of that core human expertise asset degrades permanently over time. That's a serious red flag to watch.
Okay, let's move into the final section. Valuation, risks, and bringing it all back to that central AI paradox. Starting with valuation, let's be crystal clear up front. Accenture has pretty much always commanded a premium valuation in the market, and for good reason. The market consistently awards a high multiple for its superior quality, its track record of consistency, and its structural dominance in a growing industry. If you look back over the last decade, their average price-to-earnings ratio, their PE, has generally hovered somewhere around the 26x mark. Sometimes higher, sometimes a bit lower, but typically in that mid-20s range.
Right. And today, as we record this, the current PE ratio is sitting notably below that historical average. It's somewhere around 20x earnings right now. That feels like a crucial data point, doesn't it? It suggests that the market is currently pricing in some cyclical fears, maybe worries about macroeconomic headwinds, causing a temporary slowdown in corporate IT spending. This makes the price today look, well, much more reasonable than it has been in recent memory, at least relative to its own history.
Agreed. It's definitely more palatable than when it traded north of 30x PE. But for a high-quality compounder like Accenture, the margin of safety isn't typically found in just statistical cheapness. You are almost never going to buy this kind of business at a deep value, single-digit PE multiple, unless something is seriously wrong. Instead, the margin of safety for these kinds of companies is usually found by waiting patiently for one of two specific, usually temporary, events to occur.
Okay, what are those two events?
First is the universal indiscriminate market panic scenario. Think March 2020, or maybe the depths of 2008, when capital is simply fleeing the market wholesale, selling off high-quality names right alongside the genuine junk just to raise cash. That's often a great time to buy quality.
Right, when the baby gets thrown out with the bathwater.
Yeah.
And the second event?
The second, and maybe more common opportunity, is the company-specific but temporary setback. We're talking about Wall Street overreacting to, say, 1/4 of slightly weaker than expected bookings growth, or maybe a temporary downward revision in near-term guidance caused by a short-term cyclical slowdown in client IT spending. When the market panics over that kind of short-term noise, that can be the window to initiate or add to a long-term position, provided, of course, that your analysis confirms the underlying moat remains structurally intact and the long-term story hasn't changed.
And we really have to emphasize the importance of the entry price hurdle here, don't we? Even a truly wonderful company like Accenture can turn into a mediocre investment if you dramatically overpay for it. If you had jumped in when the PE was, say, 40x earnings a few years back, you were essentially betting on phenomenal, almost flawless, sustained growth for years to come, just to justify that multiple. If the growth turned out to be merely very good instead of phenomenal, the multiple inevitably compresses back toward the historical mean over time, and your shareholder returns really suffer, even if the business itself does well.
Absolutely. Valuation matters enormously for future returns. The current position, around 20x PE, suggests that the risk of catastrophic multiple compression from here is relatively lower today than it certainly was during those peak valuation periods. It offers maybe a slightly better starting point. Hashtag 3.2 permanent impairment risks and catalysts.
Okay, so valuation looks more reasonable.
Right.
Now let's think about the true long-term risks, the kind of things that could permanently impair the moat and the value of the business. What keeps you up at night regarding Accenture?
Well, number one has to be severe reputational damage. The entire foundation of their competitive edge, that premium pricing, that client stickiness, it's all built on trust, on being seen as that safe pair of hands for critical projects.
So what could cause that kind of damage?
A few things. A massive, very high-profile project failure. Imagine an implementation that literally cripples a Fortune 100 company's operations for weeks and costs them billions. Or perhaps a severe ethical scandal involving senior leadership. Or, maybe most terrifyingly in today's world, a massive cybersecurity breach originating from Accenture systems that exposes highly sensitive client data.
Yeah, any of those could shatter that trust overnight, couldn't it? That would permanently erode their core advantage and, crucially, give clients the compelling political justification they might need to finally make the painful switch to a different provider.
Exactly. So that's risk number one. Risk number two is that structural internal one we discussed earlier, the potential failure to win the war for talent in the long run. If that high demand, high burnout culture leads to a chronic inability to attract and, just as importantly, retain the world's best specialized talent, particularly in AI, cloud, maybe quantum computing down the line, then their core expertise asset degrades permanently. Their ability to actually deliver these complex transformations would fade, and the moat would essentially crumble from within. They need the best people.
Okay. Those are the big downside risks. Now, flipping to the upside, the primary growth catalyst seems pretty clear, and it looks massive. The enterprise-wide acceleration of the AI spending cycle. This isn't just a short-term fad. This feels like a decade-long structural tailwind, doesn't it?
Absolutely, it's huge. With $3 billion in new Gen AI-specific bookings already booked in FY24 alone, this is undeniably shaping up to be the single most important driver for their future earnings growth. As companies globally realize they are forced to invest tens, maybe hundreds of billions collectively over the next decade to fundamentally rewire their core operations, everything from customer service chatbots to internal coding processes to back-office finance functions, Accenture is just uniquely positioned. Arguably, they are the only truly scaled global provider that has both the strategic insight at the C-suite level and the massive delivery army needed to capture a disproportionate share of that enormous structural spending wave. It plays right into their sweet spot.
All right, now we arrive at the absolute core of this deep dive, the central paradox we started with. It's time for the red team challenge. We have to invert the entire bull case we just laid out and ask the really tough question. Is the very force driving their current growth generative AI actually an existential disintermediating threat in the longer run?
This is the crux of it. The entire history of Accenture's premium pricing, their fat margins, their incredible ROIC, it's all been based on a fundamental economic scarcity. The scarcity of organized, large-scale, specialized human expertise. Clients paid $500, $600, $700 an hour because they needed a global army of intelligent, educated, highly trained consultants to come in, analyze their complex problems, write bespoke software code, integrate disparate systems, and manage mind-bendingly complex global projects. That scarce human expertise was the high-value asset.
Okay, so the counter thesis, the red team argument, is that generative AI represents a permanent commoditization force that fundamentally undermines that core scarcity. Is that the idea?
That's precisely the fear. Think specifically about the core services Accenture provides. Broadly, they sell three things: strategy, figuring out what the client should do; code, building the technology to how they should do it; and project management, deploying it and making sure it works. Now imagine a future, maybe 5, 10, 15 years out, where powerful AI co-pilots integrated deeply into a client's own internal systems can analyze millions of data points instantly to diagnose strategic inefficiencies. Imagine AI that can write and rigorously debug highly complex software code, maybe better and faster than human teams. Imagine AI that can even manage complex project timelines, allocate resources, and flag risks with far less human intervention. In that world, what happens to the scarcity value of the external human strategist, the external coder, the external project manager?
If the AI can do large parts of that work internally for the client, it could fundamentally degrade Accenture's value proposition, couldn't it? Their role could potentially shift, maybe not quickly, but perhaps inevitably over time, from being the high-margin brains who architect the entire transformation to merely being a lower-margin body shop, providing supplementary staff for commoditized tasks that are largely directed by the client's internal AI systems. They become just the implementation team for the AI strategy, not the creators of the strategy itself.
That's the nightmare scenario for Accenture shareholders. If that kind of shift occurs, the premium pricing power they currently enjoy and their phenomenal return on invested capital, currently well above 20%, would almost certainly compress sharply. It would likely drift down towards the industry average of the pure-play IT outsourcers who operate on much thinner margins. This is the ultimate, potentially hidden crap in the fortress. The thing the market might be missing today because the near-term AI boom looks so positive for them.
So it really changes the entire investment calculus, doesn't it? Right now, the bull case is betting that Accenture can successfully integrate AI to make their own consultants, say, 10 times more efficient, therefore allowing them to maintain margins and quality even if they need fewer people per project. But the bear case, the existential risk, is that AI primarily empowers the client's internal team, making them self-sufficient and rendering the expensive external consultant increasingly redundant over time.
And that is the absolute key distinction. That's the difference between a successful strategic evolution for Accenture using AI to enhance their existing model versus a fundamental existential disintermediation of their core value proposition. The critical question isn't really if AI can eventually perform high-level strategy work or complex coding. The trajectory suggests it probably can. The real multi-billion-dollar question for investors is the timeline. How quickly will large, complex, inherently bureaucratic corporate clients actually trust the AI's strategic recommendations over Accenture's human strategists? How fast will that trust translate into a reduced demand for Accenture's high-margin advisory goals versus just their implementation services? That timeline is everything. #outro.
That really is the critical distinction we and anyone invested in Accenture must constantly monitor going forward. Okay, so to quickly synthesize our findings from today's deep dive, the bull case for Accenture looks, frankly, overwhelmingly strong in the medium term. You have a dominant moat that seems to be actively widened by the initial necessity of this AI transformation wave. You have prodigious free cash flow generation and a disciplined, generally owner-oriented management team navigating the ship.
Right. And the bear case really focuses on two main things. First, that internal tension, the talent retention risk, the leaky bucket problem, which could degrade their core asset. And second, that huge long-term existential question mark. The risk that generative AI, which is their biggest tailwind right now, eventually turns into a disintermediating hurricane, fundamentally commoditizing the economic value of organized human knowledge itself.
Our analysis today suggests the market is currently, perhaps, overly focused on those near-term cyclical spending slowdowns, which is likely causing that dip below their historical average PE ratio. We think there's a good chance the market is severely underappreciating the structural widening of the moat that's being caused by the sheer necessity of AI transformation right now. For the next, say, 5 to 7 years at least, Accenture is arguably becoming more essential to its clients, not less.
But it underscores that this is ultimately an investment thesis predicated on management's ability to successfully serve arguably the greatest technological wave in a generation. And it's a wave that, as we've discussed, could just as easily swallow their traditional business model whole as it could propel them to new heights of dominance. It's a true double-edged sword.
And that leads us to the core puzzle, the provocative thought we want to leave you with this week. We are essentially betting on Accenture successfully mastering this technological tidal wave. But what is the exact timeline for that same wave to potentially crest and turn into an existential threat for the entire business model of organized human knowledge for hire? Answering that question, figuring out that timeline, is what ultimately dictates whether Accenture's current stock price represents a genuine bargain, or perhaps a subtle structural value trap that's just waiting a decade down the line. Thank you all for joining us for this deep dive into Accenture. We certainly hope this gave you plenty to think about this week. We'll see you next time.